Hello there. Welcome back to Accounting Space. Let's subscribe and share. Let's share our videos to all our colleagues who are doing financial accounting info. In this video, we want to look at the accounting equation. And we know that the accounting equation has got three main elements. That is, we've got our assets, we've got the owner's equity, and also we've got our liability section. So, presentation of our accounting equation, we know that it's presented in the form of assets equal to owner's equity, and then we get our liability. So we know that out of the assets, we are going to have two different forms of our assets, whereby we are having our non-current assets, and also we've got our current assets. The same applies to our liabilities. We are going to have two forms of our liabilities, where we have our non-current liabilities and current liabilities. So basically, what we are saying is that to get a figure for total assets, we're going to say non-current assets plus current assets, and then to get total figure for liabilities, we're going to say non-current liabilities plus current liabilities. So this is what we have in terms of our presentation of the accounting equation. So we are going to see that the left-hand side is which is this one, should be equal to the right-hand side. So that's how it is formulated. And we'll see that now, according to the accounting equation, the effects of the accounting equation that we're going to look at, if we are going to have a transaction that is going to increase our assets. Remember, we're going to look at transaction, we convert it to double entry, and then the two accounts involved, there might be one of the account might be on the asset section, and the other one might be on the owner's equity side. So if given this demarcation of equal sign, it means if we've got a plus here, we're going to have a plus here in the same transaction. If we've got a plus on assets and for liabilities, it's also going to be a plus. But if the transaction is affecting only the side of assets, it's going to be all the two accounts are part of assets, we're going to have a plus and a minus. Or it is affecting owner's equity and liabilities, it means if there's a minus, you have a plus. So if you are trying to get it in that sense. So we go to a question that we have there, which is question 1, and it reads, use the information below to complete the table. Example, the owner received the rent for the building that he let to Mr. Duka, which is 8,000 rands. Then receipt number, we've got receipt number 3 was issued. And this is an example that we are given, and how we were supposed to present it. We have got the source document, which is, according to this transaction, is going to be a duplicate receipt. And then the account that must be debited is bank, account credited, current income. And then if you're on account equation, you are seeing that the double entry is affecting assets and owner's equity. You've got a plus on assets and then a plus on owner's equity. Just as we were trying to explain at the beginning of the video, that if the two accounts are on different sides of the equation, remember, in this case, our equal sign is here. So we've got transaction affecting assets and owner's equity on the other side. So it means if it's a plus, it's going to be a plus on the other side. So exactly as we were trying to explain. So let's try to go to our first transaction of the question. So on our first transaction, which is one, the order increased capital contribution from 600,000 to 750,000 in as an additional capital. The owner increased the capital contribution from 600,000 rands to 750,000 rands as an additional capital. So we need to see that the capital was increased by how much. So obviously we are going to subtract between the two, whereby we are saying 750,000 minus 600,000, where we are going to get your 150,000. So obviously this 150,000 is one that we are going to effect for the double entry. So the first step is to identify double entry, the two accounts that are involved in this transaction. Remember, every transaction has got two accounts that are going to be affected. There is where we have the double effect. And then we try to see which one is going to be debited and is going to be credited. Then we can now be able to see what effect is it causing on the accounting equation. So obviously, we have got an owner increase in capital, which means we have got capital accounts there. And then we also have a bank, because this money is going to be received by the business. So we are going to say two accounts involved. We have capital, and also we have bank. So these are the two accounts. So which one is debited, which was credited? We know that when a capital is being introduced, the capital account is we credit it, and then we are receiving money. So the bank is the one which is receiving money, so we debit bank. So this is the general concept of if there's a movement of money, it's very easy to identify which one is going to be debited, which one is going to be credited. And we know that on double entry, every debit entry has got corresponding credit entry. We don't debit and debit, but we debit and credit, or credit and debit. So this is what we have. So we now try to identify which account is being affected by, which element of the account equation is being affected by bank, and which element of the account equation is being affected by capital. You see that bank is an asset, so it's going to affect the asset section. And then capital is part of owner's equity, is going to affect our owner's equity. So we can start by entering the other columns whereby we've got number, source document, and we know that the source document there, that is going to be involved there. It's going to be a receipt. Let's try to see according to the transaction that we are given. So if you come here, let's start by entering the item number, which is number 1, and the source document that we are regarding as, obviously, this transaction is money that is entering into the bank. So obviously we are going to have a receipt as a source document. So we can say receipt. Or it can come as a deposit slip, as it is deposited in the bank. So we can say receipt or deposit slip. So this is what we have in terms of source documents. Then which account is going to be debited? And we saw that the bank is being debited. So as we are saying, bank is receiving the money, and we credit capital. And then effect on account equation with asset, owner, equity, and liabilities. We are seeing that we are debiting bank, and bank is an asset. And you know that for all asset accounts, when we debit, it's a plus. When we credit, it's a negative. So we are debiting, so it's a plus 150,000 that we calculate there is the capital contribution. So it's 150,000. And also our owner's equity in terms of capital. So for our capital, if we credit, it's a plus. It becomes the opposite. When we debit, it's a negative. So we are crediting, so it's a plus again. So this is the effect that we have on our transaction number 1. Then we go to the next transaction, which reads, Miss Manda, a debtor who owes 3,500 rands, has been declared insolvent, and part of his debt is to be written off. The layers informed you that an amount of 30 cents in the rand will be paid, and the rest will be written off. So we've got a bad debt which needs to be written off there. A part of the debtor's amount is going to be written off, so it's going to be a bad debt. So basically, the key area that we have there is 30 cents in the rand will be paid. So the remainder won't be paid. So you're saying 100 cents minus 30 cents, and you're getting 70 cents, which is 0.7. So to get the proportion now, which is not going to be paid, which is 70 cents, we are now saying 0.7, 70 cents as a decimal, and then we multiply by 3,500. And the answer that we're going to get there is 2,450. So this is the amount that is going to be written off. So the double entry that is going to be involved for that, we'll try to bring it down, whereby obviously we are having a bad debt account. We're having a bad debt account that is there. And then obviously it's going to reduce the debtor's total figure that is there, because it's going to be written off, and also we've got a debtor's account. And obviously, I remember when we first sold these goods on credit for Mr. Amanda to be our debtor, we debited the amount in the debtor's account. And then now we are writing it off, means we are going to the opposite side, to the credit side. So we are crediting the debtor's account, and then we debit the bad debt account. Remember, bad debt account is an expense account, and all expense account, and for normal debit entries. So we enter that, and we go and present it in the answer section. We are here in item number 2. And the source document that is going to be involved there, we are going to see that the internal journal memo is the one that is going to be involved there. So we can go and present as such. Let's just try to see. So we go to the other section and fill in the gaps that we have. So here we are saying we have got item 2. And then our own source document we are saying is an internal journal memo. And the account to be debited, remember we said the bad debts account. And the one that is supposed to be accredited is now the debtors control. And the amount that is involved, we calculated it was 2,450, and we are debiting bad debts as an expense. And the bad debts as an expense is used to calculate the net profit figure in the income statement under operating expenses. And we see that bad debts reduces the net profit figure. And net profit figure is going to increase the owner's equity. It's part of the calculation of the final owner's equity balance or the closing owner's equity balance. So when bad debts is decreasing, the net profit is also going to decrease the owner's equity balance. So we are saying it's going to be a negative for owner's equity, which is a negative 2,450. And debtors control is an asset. And remember, we said that when you debit in the asset account, it's a plus, you credit, it's a minus. So here we are crediting debtors control. So it's a minus again, negative 2,450. So this is exactly what we have. So we go to the next one, which is going to be our third item. We go to the question part and see what we have in terms of item 3. So we are here. Let's try to see. So on item 3, it is the business established a cash float of its cash register by cashing a check to the value of 500 rands using a very interest system. So we've got 500 being cashed. So the double entry that is involved is the first item that we are going to consider there, whereby we are saying the account to be debited is going to be cash float, and the account to be credited is going to be bank. So we have got cash float and bank, and we see that this money is coming from the bank and going to the cash flow. So cash flow is going to be debited, and then the bank is going to be credited. So we come here and indicate as such, whereby we are saying now we debit cash float. Here, let's say cash float, and then we credit bank. And then on the source documents, we are going to have our, remember, this is coming through the bank, obviously. If you go back, let's just go back to the transaction to clarify in terms of the source document involved. The business established a cash flow of which cash registers by cashing a check. You see, there's a check that is being cashed. So it means the check counter 4 is going to be our source document. So we go there and include our check counter 4. Check counter 4 is going to be our source document, whereby we are saying we are debiting cash flow and crediting bank. So by debiting cash flow, remember cash flow is an asset. So by debiting an asset, it's going to be a plus. So we're going to have a plus. We check the figure that is involved with that cash flow. The figure that we are having there is our 500. So we are going to have a plus 500 on assets for our cash flow being debited. Then bank is being credited. Bank is an asset again. By crediting an asset, it's a negative, so you also have a negative other assets. So you've got a plus 500 and negative 500 other assets. So this is what we have in terms of item 3. Then we are looking on to item 4. So under the 4 items, that the bank returned Miss Vule's check for 800 rands. The check was disordered due to insufficient funds. Remember when this check was originally issued, it was already recorded in the book, so we need to reverse the recording that we've done. So at first we debited bank and credited the debtors account, which is Miss Vule. But now we dishonored. When it's dishonored, it means it was rejected at the bank. So it means we need to reverse that transaction by crediting the bank and debiting the debtors control. So we are going to credit bank and we debit the debtors control. That's the reverse double entry that is now involved. So we are saying double entry, we are going to debit debtors control. In other words, we are reinstating the amount that we've written off as payment. And then we credit a bank. And then on the source document, obviously, we can find this on the bank statement. And then by debiting debtors control, this is an asset, it's a plus. Debiting an asset, it's a plus, and then the amount that is involved is 800 here. So you've got a plus 800 under assets. And then by crediting our bank, it's a minus, so we're going to have a minus 800 under assets again. So plus 800 and minus 800 under assets. So this is what you guys are going to do this video of effects on the accounting person. Let's say to tune for more videos to come. Let's not forget to subscribe and share. We'll meet again in the next video.